In this video, y'all find out how REITs compare to real estate so you can figure out which one's best for you. Good day to you folks, Money Jim here, your money pal. Now when it comes to real estate, plenty of investors only think about brick and mortar, owning a physical property. But that ain't the only way, no sirree. You can also invest in real estate investment trusts, or REITs for short.
Oh la 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 la. Is this one of your balanced views again, Jim?
Oh hey there, John. It sure is. It's my old roommate, Muddin' John.
How many times, Jim? It's mouton, not mutton. Mouton.
Sorry, John. Never could get that right. John here got that nickname, Muddin'.
Mouton.
Yeah, that one. It's French for sheep. John sure likes to follow the crowd.
Nothing wrong with that.
Not always. Anyways, John also loves real estate.
There are too many people online saying how much money they make from real estate. How could I resist?
So John, want to help us compare REITs with real estate?
With pleasure. There is no comparison. Physical real estate is superior to REITs in every way.
Let's just see. So first off, real estate don't need no introduction. As an investment, you buy it and rent it out. Most everyday investors buy residential properties to rent them out to folks who want to live in them. REITs, on the other hand, are a bit like an ETF. You can buy them and sell them using your brokerage account. They invest in a bunch of different real estate, mostly commercial property. That can be offices, shops and malls, warehouses, communication towers, data centers, self-storage units, hotels, restaurants, you name it, there'll be a REIT for it. And they don't just own a handful of properties, they might own hundreds, maybe even thousands.
Ooh, so fancy. But you don't really own nothing. I don't see REIT investors holding the keys.
You're right there, John. That's because REIT investors pool their money together so they can invest in far more properties than they ever could by themselves. And then it's the REIT managers who buy, build, renovate, manage, and sell the properties.
Managers. I'm the boss of my real estate. No one tells me what to do.
You sure have more control when you own the property yourself. But with greater power comes greater responsibility. Tell me, John, who do the tenants go to when there's a problem with the property?
Yes, it is me.
So if a pipe bursts at 4 in the morning, who's responsible?
Oui, c'est moi.
So one of the big differences is REITs are 100% hands-off because the manager's looking after everything, while real estate, unless you paying a management company to do it for you, sure is hands-on.
Yes, well, not afraid of a little hard work, are you, Jim?
Sure ain't. Let's move on and talk about investment costs. John, you just bought a property. How much did you put down?
Hardly nothing. 20%. Sometimes a bit more, sometimes a bit less. I use the bank's money to pay the rest. Can you do that with a REIT?
What John's talking about is using leverage. That's borrowing to invest. So with a mortgage, you can buy a property worth a lot more than you got in cash. Now we know REIT investors can't use leverage like real estate investors. REIT managers can, so they can borrow money and take out mortgages too. So if you look under the hood of a REIT, there's almost always leverage being used. So even though mortgage real estate lets you buy more than you got in cash, you also got all the ongoing costs. Don't share those with the bank. So whereas a property down payment is going to cost you tens of thousands at least, and maintenance and repair costs can add potentially thousands more, you can invest in a REIT starting with not even $100.
What is that phrase you Americans always use? Go big or go home.
Touché, John, touché. By the way, if you found this useful so far, go hit that subscribe button because we got plenty more content coming up. So moving on, let's talk taxes.
Something you cannot argue with. I can lower my taxes to next to nothing. I can deduct my mortgage interest, property taxes, insurance, repairs, everything. And the pièce de résistance, I get the right of depreciation. Part of the building's value every single year, even as the value goes up. C'est magnifique.
He's right. tax benefits of real estate are real handy. With REITs, you don't get the same perks. Not only that, REIT dividends are normally taxed as ordinary income, so you could end up paying pretty high rates of tax.
Not so good now, are they,
Real estate sure got REITs beat when it comes to taxes. But what about the most important one of them all, the one most investors looking for when investing in either real estate or REITs? Income.
Ah oui, j'adore income. I love it. Cash flow, money coming into my pocket. Just like that rich dad poor dad guy said.
Now the average yield on residential real estate, that's the annual income divided by the property value, is around 6%. That's $6,000 for every 100 grand of property owned. The yield can be lower in expensive cities where property prices are sky high, and it can be 12% or more in other places where property ain't so expensive. But don't forget those yields before you deduct any costs you're paying. Now REIT yields can also vary a lot too. Heck, there's some even yielding 20% or more. But don't forget, yields go up when prices fall. So don't just go chasing the highest yields, because there could be trouble going on. If we look at the global REIT market, which is nearly 90% US REITs, the average yield's just under 4%. All the costs REITs gotta pay already included in that yield, so the only deductions you gotta make are taxes and your broker costs. Even so, while there sure are high yielding REITs, in general you can earn more income from physical real estate.
And when you use debt, those yields are even higher. Say you buy a property for 200,000 and you put down 20% and earn 12,000 a year in rent. That's a 6% yield, but you're actually getting 30% annual return on your 40,000 investment. Voila! The magic of leveraged real estate investing. Just like that Grant Cardone said.
Ah, but you're forgetting something real important.
What's that?
Interest on the debt. See, mortgage rates currently over 6%. So after you pay that, you might find you ain't making any money at all, or even losing money.
What? That's not what all those highly credible and trustworthy real estate gurus told me.
Mortgage rates got as low as 3 to 4% in 2020, but according to Freddie Mac, the average rate since 1971 is 8%. So using debt could actually make you less money or even lose you money if the interest rate is higher than your income yield. Now, of course, it ain't all about income with REITs and real estate. There's the opportunity for gains too.
Ah oui, and if I pay just 20% of the property, I get to keep 100% of the gains. If the value goes up 10%, I make a 50% return.
Leverage sure does make those gains bigger. But of course, there ain't no guarantees your property will go up in value. It could even drop. Remember 2008?
I tried to forget about it. Mon Dieu, that was horrible. But how did REITs do, eh?
They sure didn't do any better. In fact, they did even worse than stocks, and that took some beating. But that's just 1 year, and a mighty bad one at that. So let's look at the longer term. You can see that REITs fell a long way behind stocks over the past 20 years, but that ain't what we're comparing here. So REITs' 20-year gain was just 57%. That's an average of about 2.25% a year. That compares with a 20-year gain in the average US house price of 78%. That's about 3% a year. Still ain't much, is it? But don't forget, those figures just the price gain. They don't include the income. So while real estate beats REITs in price gains,
Naturellement,
neither was nothing to write home about. So if it's gains you're after, probably don't go for either real estate or REITs, because it's income where you will find most of your rewards. So to wrap up,
REITs are terrible. Less income, smaller price gains, no tax benefits.
you got a lot of good points, John. REITs are generally for folks who want to invest in real estate, but don't want to invest as much time, money, or effort as when you own the property yourself. And those are some pretty valid points too.
That's not good enough for me. 1 second. Oui, allô? Oui? Non. Oh no.
What's up, Sean?
It's my tenant. Burst water pipe. Oh la la. Au revoir, Jim.
Au revoir, Jean. So what do you think's best for you? Real estate or REITs? Or maybe neither? Don't forget, if you want to see more content like this, be sure to like and subscribe. See you next time, sunshine.